Imagine this. You walk into a store in America with $1. Then you fly to London, and suddenly that same dollar is worth less than £1. Then you go to Indonesia, and now it's worth 17,000 rupiah. Same dollar, completely different value. So, who decides what money is worth? And why do exchange rates change every second? Today, we're breaking down how currency works, why money isn't equal, and what really controls exchange rates in the simplest way possible. Money feels simple when we use it every day, but behind every currency, dollar, euro, ruble, there's an invisible system constantly deciding its value. To understand why currencies are different, we first need to understand what money actually is. And no, it's not gold. It hasn't been for a long time. And trust me, the answer is going to surprise you. Here's the easiest way to see currency differences in action. Take a Big Mac. In the United States, a Big Mac costs about $5. Walk into a McDonald's in Switzerland, that same burger costs you $7. But fly to Egypt, you're paying less than $3 for the exact same burger. Same burger, same McDonald's, wildly different prices. This is called purchasing power, and it reveals something crucial. Your dollar doesn't buy the same amount of stuff everywhere. In Vietnam, $5 gets you a 3-course meal with drinks. In Norway, $5 barely covers a coffee. But here's where it gets wild. Why does this happen? The answer? Your money is only worth what people believe it's worth. And that belief changes based on trust. When people trust a country's economy, they want that currency. When trust breaks down, the money becomes toilet paper. Let me show you what I mean. Picture this. In the 1980s, if you had one Zimbabwean dollar, you could trade it for $1.35 in American money. The Zimbabwean dollar was actually stronger than the US dollar. Fast forward 20 years, same Zimbabwean dollar, now worth 0.0000167 cents. You'd need 600,000 Zimbabwean dollars just to buy one US dollar. What happened? The government broke the trust. They printed money like crazy, thinking they could solve economic problems by just making more cash. But here's the brutal truth. You can't print your way to wealth. More money chasing the same amount of food, cars, and houses just makes everything more expensive. That's inflation. And when inflation spirals out of control, called hyperinflation, people lose faith completely. Zimbabweans stopped wanting their own currency. They literally abandoned it and started using US dollars and South African rand instead. Their money became so worthless, people used billion-dollar bills as wallpaper. I'm not joking. So, money is just trust. But how do you keep that trust strong? Here's where America pulled off the most genius financial move in history. After World War II, the US made a deal with Saudi Arabia and other oil-producing countries. Sell your oil only in US dollars, not euros, not rubles, only dollars. Why does this matter? Because every country on earth needs oil for cars, planes, factories, everything. If you're Russia and you want Saudi oil, you can't just hand them rubles. You must buy US dollars first, then use those dollars to buy oil. This created permanent artificial demand for the US dollar. It's like if McDonald's said we only accept Disney gift cards. Suddenly, everyone needs Disney gift cards, making them super valuable. That's the petrodollar system, and it's the reason the US dollar dominates global finance. Countries stockpile dollars just to buy oil, which means America's currency stays strong even when their economy has problems. It's basically the ultimate cheat code for currency strength. And yes, there are rumors Saudi Arabia might start accepting other currencies now, which would be absolutely massive for global economics. Now let's talk about how countries fight for your money without you even realizing it. Imagine you have $10,000 to invest. You can put it in a German bank that pays you 1% interest per year, or you can put it in an American bank that pays 5% interest. Where are you putting your money? America, obviously. That extra 4% is free money. When the US Federal Reserve raises interest rates, they're basically turning on a giant money magnet. Rich investors and foreign governments around the world start selling their euros, pounds, and rubles to buy US dollars so they can invest in higher-paying American bonds and savings accounts. More people wanting dollars, dollar value goes up. When the Fed cuts interest rates, the magnet turns off. Investors pull their money out and chase better returns elsewhere. Dollar demand drops, dollar value falls. But here's the catch. You can't just jack interest rates up to 20% and call it a day. High interest rates make borrowing money expensive. When loans are expensive, people stop buying houses, businesses stop expanding, the economy slows down, and unemployment rises, and things get ugly fast. That's why everyone freaks out when the Federal Reserve Chairman makes announcements. One sentence from this guy can move trillions of dollars around the planet in seconds. Central banks have to walk a tightrope, high enough rates to attract investment and control inflation, but low enough to keep the economy growing. It's like playing economic chess with a blindfold. Here's another way countries boost their currency. Make everyone want to do business there. When China opened up to foreign investment in the late 1970s, something crazy happened. American, European, and Japanese companies rushed in to build factories. Nike, Apple, Toyota, everyone wanted a piece of China's cheap labor and massive market. But here's the thing, if Ford wants to build a factory in Shanghai, they can't pay Chinese workers in dollars. They need yuan, Chinese currency. To buy land, yuan. To pay suppliers, yuan. Everything requires converting dollars into yuan. Suddenly, there's massive demand for Chinese currency. More demand equals higher currency value. China got rich not just from selling products, but from everyone needing their money to do business there. That's why every country tries to attract foreign investment. Stable government, clear laws, low taxes, good infrastructure, these things make investors comfortable putting billions into your economy, and all that money flowing in strengthens your currency. On the flip side, countries with political chaos, random rule changes, or corrupt governments can't attract investment. Nobody wants to risk their money where the government might seize it tomorrow. Weak investment equals weak currency. Every time Japan sells a Toyota to someone in Europe, Europeans have to buy Japanese yen to complete the purchase. Every Samsung phone sold in America, someone's buying Korean won. This is why countries obsess over exports. The more stuff you sell globally, the more people need your currency. More demand equals stronger currency. China figured this out decades ago. They purposely kept their currency value lower to make their products cheaper for everyone else. If a Chinese factory widget costs 10 yuan and they keep the yuan weak, that widget becomes super cheap in dollars. Americans buy more Chinese products because they're affordable. Some people call this currency manipulation. Others call it smart economics. Either way, it works. Some smaller countries took a different approach. Why struggle with our own currency? Let's just copy someone successful. Brunei said our dollar equals Singapore's dollar, 1-to-1, done. Now both currencies have identical value and you can spend either in both countries. Easy. Belize went even simpler. One Belize dollar always equals 50 US cents. Always. No fluctuations, no surprises. The math is easy. The downside? You're completely dependent. If the US dollar crashes, Belize's currency crashes with it. You're married to that currency for better or worse. But for small countries without strong economies, it's often the smartest move. So why don't we just create one global currency and end all this exchange rate madness? Because the euro already showed us why it's dangerous. When Greece's economy collapsed in 2009, it couldn't just print more money or adjust interest rates to save itself. Why? Because Greece doesn't control the euro. A European central bank does, and the ECB has to think about all of Europe, not just Greece. Germany, France, and other strong economies got dragged into Greece's mess because they share the same currency. One country's problem became everyone's crisis. Now imagine that on a global scale. If Brazil screws up its economy, suddenly your money in America loses value. If India faces hyperinflation, your savings in Canada take a hit. One country's disaster is everyone's disaster. Different countries need different economic tools to solve their unique problems. A single currency takes away that flexibility. So there you have it. Currency values aren't random. They're the result of trust, trade, interest rates, and sometimes straight-up geopolitical power moves like the Petrodollar system. Your dollar is strong because America forced the world to need it. China's yuan is rising because they became the world's factory. Zimbabwe's currency died because trust collapsed. Understanding this stuff gives you power. Whether you're traveling, investing, or just trying to understand why your money buys less every year, this is the game being played behind the scenes. If you want me to dive deeper into currency manipulation, how governments actually devalue their money on purpose, or the future of the petrodollar, drop a comment below. Hit that like button and subscribe for more economics explained without the boring lectures. Your money just got smarter. See you next time.